Hello, ladies and gentlemen. After coffee break, I'm sure we are in very good mood. With us is Mr. Tytus Cytowski. Thank you very much.
Hello, everybody.
Yes, let's start.
Okay, so I'm going to talk today to you about startup finance, from crowdfunding to debt and equity. And I guess everybody is here to learn more about crowdfunding, how to talk to VCs. I saw that Peter Wilam was stocked almost. People were giving him business cards. Things were crazy. I also want to talk about Christmas because we're in the season of giving. I'm not going to give you advice about how not to pay taxes. I want you to be tax compliant. And I really like friendship, so we can be friends. But if you want to talk to me about your legal stuff, I have to turn the clock on, and we need to sign some paperwork. So let's get that straight. I know, life's a bitch. Okay, so that's me. I work a lot with VCs in the US, angels, and I also work with startups from Europe especially that are coming to San Francisco and New York looking for investment or are in the process of crowdfunding in the US on Kickstarter or Indiegogo. We're a boutique firm. We have an office here in Poland, but we focus mostly on work in New York and San Francisco, where our two main offices are. Okay, so what is startup finance? Anybody? Any ideas? Cool. This is going to be interactive, so I want you to say something. Silence. Okay. Typical polls. Money for shares. Okay. We have a real founder there. Cool. But you know what? It's not about that. Startup finance is not this. It's not Santa Claus coming to you with a sack of goodies. It's not. And it's a big misconception that financing is about that. Actually, it's this. Fundraising is super hard work. Either in crowdfunding or doing things with debt or with equity, it takes a lot of time and it takes a lot of effort from you. Typical fundraising, it takes up to, it can be as fast as 3 weeks, and it can go up to 5 to 6 months, depending on the deal. So you have to understand the process and be comfortable with the process, and you cannot get frustrated about how long it takes. You have to jump through a lot of hoops, and you need to understand the process. So the process of getting a term sheet, pitching a VC, then going from the term sheet to due diligence, and finally signing the documents. So, letter to Santa Claus. I know everybody's excited. Who wrote a letter to Santa Claus before? Anybody? Yes, come on. So many cynical founders here. Raise your hands. You had to write letters to Santa. Nobody wants to get free things? Email is good. I'm at Cytowski at CYT Law. Okay, but seriously, these things, these are typical things that you usually ask about when doing fundraising. So today or 2 days ago, I got approached by one of my clients. What is our valuation? So he started a crowdfunding campaign on Kickstarter, and one of the VCs just approached him and asked him, what is our valuation? And the guy's like, dude, what's my valuation? What's my worth? What should I ask for? So if you're a little kid writing to Santa Claus, AKA the venture capitalist, this is your parameters. So if you look at the friends and family, it's you're trying to get a $10,000 check, the investment size, your valuation more or less, and the stage where you are. So it's idea, and you might have a business plan. If you're doing an angel investment from the guys in Krakow, I'm not going to tell you their names because everybody knows them. Those are the things you should be already have. So you have a full-time founder, so someone has to be there 100%. You need a plan. You need to have customers. Hopefully you have customers. We'll talk about that. You have a pilot with someone, and you might have revenue. So it's not a must, but like the more things you have, and then the legal documents, and then your valuation goes up from 1 million to 5. The investment size goes up, and I think a lot of you will ask me, where did I get these numbers from? They're from AngelList. So if you are going to be fundraising in the US, and I'm going to be mostly talking about fundraising in the US because I practice there, register your startup on AngelList, because VCs, angels, are going to be looking at your profile there. So you need to have that in place before you do any fundraising. Any questions? No questions. We'll get there. We'll get there. Okay. Okay. So letter to Santa Claus. I think this is like one of the most important things here. Okay. So cap table. So do people know what a cap table is? So you know. Everybody else is silent because it's cold in Poland, and they don't want to get involved. Okay, a cap table is a list of shareholders, and you list everybody in the cap table in Excel. And in that Excel spreadsheet, you write Johnny has 500 shares that are vested, and you show this to your investors when you're fundraising and you're trying to finance your company. This, you'll probably have 10 million shares. 8 million will go to the founders. Around 2 million are going to be left in reserve. I know this is a crazy idea because in Poland you have spółka z o.o., which cannot own its own shares. And in the US, a company can own its shares and it's left for investors. So the cap table is super important, and it's always, let me tell you, it's always messed up by the founders. Founders think like, oh, I'll add some numbers here, I'll add numbers here, and then it'll sort of work out. It doesn't. All of the numbers have to like add up. So if you have 10 million shares, 8 million goes to founders, it all has to add up. Okay, so the valuation. So in finance and startup financing, this is going to be the area where you're going to be discussing things with your angels and your venture capitalists. In general, valuation is not a science. It's not a hard science. It's more of an art. Because in a traditional company, you value either assets or cash flow or other things. And here in a startup, there's really no assets. There's no cash flow. So it's more of an art. So you have to be pretty, realistic. And why is valuation important? Because the higher the valuation, the more shares you have, the more power and juice you have for your investment. Okay. This is, highly contested conversation in financing. So you usually want to have the finance, if you're doing a price round, so equity, you want to have this conversation at the end, which means you already discussed all of the technical, heavy-duty things, and then you leave the hard thing at the very end. Okay, so build relationships, communities, then raise money. I know this is crazy because most people ask for money first, and then they get nothing. So in general, try to build a relationship with someone before you pitch them for money. It's like super, a lot of Westerners are really, they feel jumped by founders from Eastern Europe that, they don't listen and then they just want to get money. It's not about getting money, and getting money from investors is not a key matrix of success of your startup. The key success is getting customers. So Startup Finance 101, raise money after you get customers and you have traction. Try to bootstrap as much as possible. And this is applicable in the US, and it's applicable in Poland. And I might, go against my own interest as a lawyer, and I'll tell you, bootstrap as much as possible, invite your friends and family to take equity, and also don't be too generous about giving away equity, but bootstrap, build a community around yourself, and then maybe ask for money. Okay. Startup finance. So any person who is in finance or experienced finance knows that there's a lot of risks. And venture capital, it's like there's so much risk because they're paying you to make some mistakes, and they're borrowing money from other people. So in general, it's all about pricing risk. So the more honest and upfront you are about who you are, where you came from, and where you want to go, and what type of risks you have, the better. So you can price your equity or your debt, or do your crowdfunding. So like be super, there's two schools, but in general, disclose your risks. Okay, so if there's more risks, you need to give more. So if you have a lot of risks, you need to give up more equity, or you need to pay a lot more for the interest. And usually people from Eastern Europe have a problem with this, giving up more. And sometimes all of you are entrepreneurs, and maybe this is your first deal, and you might not get a great deal with your investor or your angels, but at the end it doesn't matter, because there might be a situation down the road where the investor might need something from you, and then you'll be playing super hardball. Okay, so whoops, you can sell a lot of things for money. I know some people here tried to sell me their kids. I don't buy kids, but so you need to give things up. So you can either give up equity in your company, and we'll talk about what's acceptable. But I'll tell you right now, if a venture capitalist, how many of you are trying to raise money like right now? Hands up. How many already raised money from VCs? Okay. So if an early stage investor tells you that they want 30% of your company, or maybe 40, is that good or bad? I can't hear you. You're a lawyer. You said it depends. No, so seriously, early stage, it's like 10% max, 5. There's 2 investors at this conference that I dislike. I'll be super honest. One is speaking, not that they spoke, and like he took a lot of shares in a startup, and I'm like, guys, you got to be crazy. This is unfair business practices. And she said, oh, there's so much risk, and that's correct. But when I came in to clean up the deal, we told her, I think you're in the wrong business. You're in the private equity business, not in the venture capital business. Okay, so equity, you can do debt. In the U.S., there's such a thing as a convertible note, which is a debt instrument. It's like a vexel, which converts. It's a loan that converts into shares of the company down the road, and we'll talk about it briefly. And then you can do crowdfunding. Crowdfunding is super popular right now because you get to do at least two things at the same time. One, you do product market fit to show that you have traction. You build the community and the relationship. All of those hate comments on your Facebook page or crowdfunding. I'm not going to take this one. It's all important, and then you don't have to give up equity. Oculus raised $2 million on, I think $2 million on Kickstarter. They didn't give any equity away. So Kickstarter, Indiegogo, there's other platforms. In general, my suggestion is, go on Kickstarter or Indiegogo, because there's communities built around that, and you don't have to reinvent the wheel. Okay. Crowdfunding finance is easy. What about US taxes? Have you thought about that? So you're 5 guys in Poland. You set up a company, let's say with me, and oh no, you didn't set up a company with me, but you did it all by yourself. And then what? You did it by yourself, and then you got all of this money. What do you do with it? Can you transfer it to Poland? Well, I know everybody wants to transfer the money to Poland. What has to happen first? You have to pay taxes in the US, right? Maybe. It depends. Okay. I love the enthusiasm, guys. I know it's late, but if you want to be in the valley pounding the pavement, you got to be more enthusiastic, at least for me. Anyway, so is it income? Unfortunately, money that you raise on crowdfunding platforms like Kickstarter and Indiegogo, they're considered income in the US. So you need to pay tax on that. So you'll pay tax on that in the US, and then you can transfer all of that into Poland. However, there is a glitch. Also, some of it is a non-taxable gift. So some of the money will be considered as income to the company, and then part of it will be considered as a non-taxable gift, which makes it interesting. So if you're doing you're going to give the guy a postcard in exchange for the product or their money, or you send them a pen, that would be considered a non-taxable gift. So you wouldn't be paying taxes on that. So you should keep that in mind. And there's a $14,000 exclusion for non-taxable gifts in the US. So some of it would be not taxed. Okay. So another thing. So you guys decide to incorporate in Delaware, let's say. And yes, you should incorporate in Delaware. Or you're in New York. As you realize, there's 50 states in the US. And each state has its own sales tax. So you need to pay a sales tax if you're operating in California or if you're operating in New York. And each state decides on its own terms about the sales tax requirements. So you need to talk to your accountant about that in the US. Any questions? Controversies? Nothing. Okay, I love it. I must be super clear here. Well, that's a good question. Yeah, but it's called pre-order sales. So I guess it's a sales, right? You can do that, but you have to plan that in advance. To plan the costs, how much you're going to pay the cameraman to do the film, right? Legal, you can all put that in advance, but unfortunately, most crowdfunding campaigns in the US end in failure. They don't hit their targets. So like the big success stories that came out of Europe recently are the outliers and the exceptions, not the rule. It's not like a magic formula. But the question about cost is important. Okay, convertible note. So this is super popular right now in the Valley. And then there's a lot of instruments that work like convertible note. So there's the SAFE. This came out of Y Combinator. And then from 500 startups, they created a convertible note that's called the KISS. It's Keep It Simple Financing. Americans love abbreviations. So, and SAFE is, Stan, what did SAFE stand for? Yeah, I forgot about it too. But, okay, so the way a convertible note is, simple agreement for equity. So the guys at YC created this. So how does a convertible note work? So it's a loan that converts into debt. So the most important thing is, how do you convert debt into stock? So there's actually two things in the convertible note. And the convertible note is maximum 10 pages. If you see a convertible note with like more than 10 pages, it's, you should, run away. So there's the discount rate. So for each dollar, you get a discount of 15, 20, or 30% on the price round at a later stage. And then you should be converting, if you're on the investor, you should know what you're converting into. So you shouldn't be converting into common stock, you should be converting into preferred. And that's very important. The final thing is, in the conversion mechanism, is the valuation cap. As an investor, so let's say I'm investing in a company, I want to know the maximum valuation that the company will be valued, because there have been founders that jacked up their valuation to $10 million and they have nothing, right? And then they jack it up to 20 and the investor is screwed. Okay, so the valuation cap is very important. Okay, so equity. So most the equity rounds, you're selling preferred shares to investors, and the preferred means that there's super privileges on these preferred things. And the key term on the priced equity rounds is the liquidation preference. Do people know what a liquidation preference is? This is the most important thing that you need to know. So wake up. Okay, you must be an investor or a lawyer or one of the two. So liquidation preference. So for the people who raise their hands that they're doing a round right now with investors, you need to look at the liquidation preference and understand how it works. So a liquidation preference means that the investor can get his money back at whatever he invested, right? So let's say he invested 50, and then after that 50, depending if it's a participating liquidation preference or a non-participating preference, he can get more money out of you, the founders. So we want to make sure that you have liquidation preference that's non-participating. So that's super important. And if you don't understand the math, you need to have someone show you how the math works. A lot of founders that are bad with math ask for a spreadsheet that describes how the math works, and that's attached as a schedule to the stock purchase agreement, or the umowa inwestycyjna in Poland. Okay, so size matters, really. So size matters in liquidation preferences, because the more shares you have, or the venture capital firm takes from you, the bigger their return. So size matters. It matters in the size of the equity. So the more shares you can preserve for yourself, the better. And your exit is going to be a lot bigger. And speaking of exits, how many people think you're going to get a salary as a founder? Should you add to the financials your salary? Yes, no, maybe. Depends. Yes. Who said it depends? And that's the correct answer. Why? Why do you think it depends? And that's the key question. So anybody here who works for a venture fund? Yeah, so the guys from the venture fund will tell you, and by the way, I've just identified the VC everybody's going to storm. The VC will tell you during the negotiations you should not take a salary because your return is going to be your return on investment. So a lot of like founders from Eastern Europe, and it's not only Poland, but it's also from Bulgaria, Romania, all over, they're interested in getting a salary, a car, and like startups are not about this. It's only about your equity and your exit. That's when you get paid. And that's what most investors in the Valley and in New York will tell you. So if you're expecting a nice salary and a good living after getting financing, you're totally incorrect. You need to like struggle a lot to get to the next stage. Option pool. So option pool is very important for financings because you're giving away a lot of equity out of your company as founders to future employees. So a lot of times in the negotiations, you want to keep the discussion about the option pool out of the conversation because you don't know how many employees you will have, and those option pool shares will come out usually out of your piece. So you don't want to have this conversation with the venture capitalists during the financing about the option pool because they'll tell you it'll have to go out of your pocket. So we don't want to talk about option pools. Okay, thank you. Like us on Facebook, follow me on Twitter, and I'm open for questions. So let's do a Q&A. Yeah. Option pool? Wait for the mic.
Okay, so what you said basically means that unless we have an exit plan and we want to exit, we don't get paid, right?
Yes.
What if I want to keep the company?
So why
I
are
don't
you...
get paid forever?
Yeah, I mean...
Theoretically.
I think a normal investor will tell you, you know, if you want money, you need to give something up. And the investor is not in the business of giving you money out. He's not Santa Claus. He wants a return on his investment. And you have to understand that. And he wants to, you know, either sell the company or exit in some other fashion. Yep. Correct. But, you know, after 5 years of struggling with you and doing, you know, 1, 2, 3, 4, 5, A, B, C, D, E, F round, you know, no one wants to do buyback shares. At an early stage when a founder, you know, stops working, they can do that. Okay. Any other questions? Yeah. Sure, that's a very good question, actually. So usually what happens is there's venture capitalists compete for deals. And when your startup is super hot, they compete and they create, you know, syndicates. And in the syndicate, you know, they have the lead VC who negotiates the terms and everybody trusts him, and then everybody signs on. But a super interesting question is what happens when you have an A round, a B round, and a C round, and how do they share the money between each other, right? So there's two ways to approach this. One is the stacked approach. So stack is the last guy gets everything, if there's a liquidation event, or there's the proportional approach, so they share all together. And the pro rata is, typical. And like to crunch the numbers for like an A, B, C, D, E round to do the pro rata, you need to have like, a really good associate to like do the numbers. Okay. Okay, no more questions. One more.
Oh, it's just been driving me crazy. I can't place where the SantaCon stuff.
Oh, so SantaCon, it's a bit of them are from New York and San Francisco. Yeah, so by the way, on Saturday there's SantaCon in the U.S. and people dress up as Santa Claus and elves, and then they do silly stuff. Okay, thank you.
Okay, thank you. And I hope we'll see you in 10 minutes for the next lecture.